Hi, welcome back. You're watching MF Corner. Now, we've always heard of valuations when we hear people talking about stocks. But have you heard of a concept where you can check the valuations of a mutual fund scheme? I'll admit that, it's a relatively new and unheard of concept for me. So let's learn together. Feroze Azeez, Deputy CEO of Anand Rathi Wealth Management, joins in. Hi, Feroze. Good afternoon. Thanks much. I know, it must be par for the course for you guys. So let's start at the very beginning because it's new for us, right? Even when we talk about stock valuations, I've heard a lot of retail investors get confused because they often think that we're referring to the stock price and they say whether it's cheap or expensive. So to begin with, tell us what exactly do we mean by valuations?
From a perspective of valuation, generally, like you said, Sumaira, it's used in the context of stocks, and in the context of mutual funds, we generally don't use valuation. We use performances, we use risk measures. Valuation for a stock, if that's important, then it's important for a group of stocks, which is what an equity mutual fund is all about. Valuation is nothing but a concept of how much price are you paying for a stock for the value you're getting. For example, the most popular nomenclature used in the business of valuation is price to earnings. So if you find out the price to earnings of each stock in the basket and find out the aggregate P ratio of the mutual fund, then it will be the valuation of the mutual fund using the PE method. So valuation is very critical. If it's critical for stocks, it's also critical for a group of stocks.
So we have valuations for stocks which are given out already, right? How do you or how does an investor therefore extrapolate that to the mutual fund? I mean, you go through the entire stock list and then what?
No, I think fortunately, this is the PE ratio of the basket is published in the fact sheet. So PEs of the entire portfolio in the weightages the stocks have been allocated in the portfolio is available in public domain. So point one. Also another valuation method, which is price to book, which is another valuation method, is also available. To answer your pointed question, Sumaira, these are available in the public domain and they're also a part of the fact sheet for you to be able to compare one scheme with another. I met an investor recently and he was worried about the elevated market levels and he was selling all equity funds without looking at which one should he be more worried about. So valuation becomes a great decision input in portfolio management, not just portfolio creation.
Okay, but what is not available in public domain, I believe, is this PEG ratio measure that you use. So what exactly is it? How do you measure it and where can an investor or where can I look for it?
Yes, the PEG ratio is one step ahead. PEG ratio is nothing but price to earning divided by the growth of the entire basket. That's why it's called PEG, PEG. The PE ratio divided by the growth anticipated of the group of stocks is called the PEG ratio. For example, if you look at Aditya Birla Frontline, it has a P ratio of the entire basket is 18 and Axis Blue Chip P ratio is 30. So if you look at P as the measure of valuation, Axis Blue Chip clearly is far more expensive than the Aditya Birla Frontline. But both these mutual funds have a PEG ratio which is as close as it could get. Both are close to 2. So what happens is the PEG ratio helps you understand what is the PE you are paying for the anticipated growth. Lesser the PEG ratio, the better it is for the scheme. So PEG ratio becomes a very good measure of valuations to be able to compare apples and apples rather than apples and oranges. So growth, anticipation. So this is one thing which may not be available in the public domain, is available in the research which Anand Rathi does on mutual funds, and that's available indirectly on our website.
Okay, so just to be clear, what we're trying to ascertain over here is whether an investor is paying too much with respect to the future potential of stocks in that basket, right, in that scheme that they have purchased. or they have invested in?
Yes. Yes. The ideal PEG ratio is less than 2, and lesser the better. So just looking at PEs might guide you in the wrong direction. From price to earning, you have to compute the PEG ratio, and that becomes a very good indicator. For example, if you look at the PEG ratio of a scheme like HDFC Top 100, that's only one PEG ratio. It can also indicate to you what's the future potential of that scheme. If it is at a lower valuation, then there is larger potential of a scheme's performance reversal. So I think that's the job of an advisor. But I think now that we are sitting home in certain cases and you have the time, please create some curiosity to get a sense of what these valuation measures are. So what's the conclusion to be derived is one valuation method cannot be seen in a silo. It needs to be seen in conjunction with other valuation methods to be able to choose schemes to buy or to sell or to continue holding.
And the reason Feroze says not only to look at PE is because, there are various sectors that the scheme invests in, and every sector has its own PE, and therefore, just one overall number doesn't cut it. But Feroze, just to end, is a cheaper fund always better, or do you need some sort of a qualitative analysis as to, why somebody is paying more for a certain stock? Is that required, or you just see the PEG ratio and go with a cheaper fund?
You're right, Sumaira. You brought me to the right topic. I think in spite of valuations being cheap, they can continue to remain cheap. If like HDFC Top 100, which we just spoke of, has a lot of PSUs in the portfolio. So PSUs historically have always been cheap. So if it's cheap and if it remains cheap, then you will not get the performance. So cheap is not good enough. That's a very important variable, though. Like, for example, we look at a forward-looking analysis. We also calculate at Anand Rathi the target NAV. We go into each stock's target return and then calculate the target NAV. So to answer your pointed question, valuation is not the only method. Cheap is not always best, but cheap is definitely one important criteria depending on the contemporary situation. If you're worried about elevated market valuations, then looking at the valuation of the portfolio is critical, and not just being agnostic and looking at the rear view mirror only.
All right, Feroze, thanks very much for joining in and for explaining that. I've learned something new again today. So that's how you measure the valuation for your own equity scheme. You can, go and try to find the PEG measure and see, how cheap or expensive it is. But as Feroze said, that shouldn't be the only criteria. With that, we'll wind down on MF Corner. But as we do that, here's a quick reminder of a daily series by Money Control Pro's ACE research team, Ideas for Profit, which gives readers investment arguments for a company. The comprehensive article covers analysis of a company's financials, business prospects, industry trends, and valuations.